The ETF industry has been in the business of disrupting and improving investor access for more than 30 years. On the front line of all this innovation are the product providers themselves. Here, we get to hear their stories and learn what it takes to be a disruptor. This is Wavemakers. Hi, everybody. I am Cynthia Murphy, Head of Research for the ETF think tank. And today on Wavemakers, we have a great guest, Ben Harburg, who is founder of CoreValues Alpha and portfolio manager of a new ETF, ticker CGRO, CGRO. Welcome, Ben.
Thanks for having me.
I'm excited you're joining us all the way from the other side of the world in Abu Dhabi. So thanks for making the time. And we're excited to hear the story because you guys are new to the ETF space. You live outside of the US. So I thought we could start a little bit of you telling a little bit about your story, what you've been doing up to now, because this ETF is new. How did you get into the asset management world? I know you live in China, at least most of the time. So tell us a little bit about yourself.
Yeah, sure. Home is Beijing. I was just actually in Beijing the last 10, 12 days. So just came here at the beginning of the week. And then moving my way towards the US next week. So kind of slowly making my way across the world. My background and our background as a firm is on the private market side of China. So we started in 2015 investing in the Chinese private venture and growth stage technology markets. We've had both of those as independent fund strategies over the last now coming up on 8 years. We've had multiple vintages of funds. So now we're on our third vintage of venture funds, our second vintage of growth funds, and probably about 150 portfolio companies or so across those strategies. We also have other asset classes as well under the hood. So we have an emerging market fund. We have a kind of US tech growth fund as well. So combined assets under management on the private side exceeding $2 billion. So as you said, CoreValues Alpha is the brand of our ETF strategy and family of ETFs. The first of which is called CGRO, meaning China growth. So it's a greater China growth ETF. But in the firm's background, it's obviously been for the last, I'd say, kind of 6 or 7 years of that 8 years in China, pretty good run. The Chinese market has been battered over the last couple of years, but prior to that, it was really an incredible amount of value creation. We were fortunate to be investors in many of these sectoral leading companies within most of the kind of major venture-backed verticals and technology and life sciences verticals. So, China's leader in food delivery, China's leader in ride hailing, China's leader in micromobility, China's leader in electric vehicles, of kind of the next generation EV brands. China's leader also in life sciences verticals like gene sequencing or big data for healthcare. And we really did a good job of picking our spots, and that's because we have an incredible team of about 30 Chinese national investment analysts and investors, partners, vice presidents, all sitting in Beijing, with their ear to the ground, understanding the regulatory evolutions of China, the sectoral evolutions, sector specialists. We have 6 PhDs, for instance, on staff, just on our healthcare team. We have a core technology team. We have a consumer internet team. And so that proximity to the regulators, proximity to the companies, to the universities, to the research labs, built us an incredible deal flow pipeline and diligence capability. And so, of course, now the objective was to take advantage of what we thought was an overcorrection on the Chinese public markets and leverage all that information we have to kind of arbitrage what is news on the Western front of the world when it comes to China and the realities on the ground. And then we marry that with my personal background, which is not just in China investing over the last 8 years, but also really straddling US-China relations and kind of dealing with the geopolitics of the relationship every day, both China vis-a-vis the US and China vis-a-vis other markets, for instance, emerging markets in South Asia, Southeast Asia, the Middle East. And so I sit on boards of think tanks and nonprofits and foundations that straddle the US and China, and that gives me a significant amount of insight into Washington, New York, what's coming down the regulatory pipeline, what's coming down the policy pipeline. And so we've been able to get years ahead of, again, a lot of those evolutions. And the objective, again, there is to be beneficiaries rather than victims of the geopolitic tumult. And then the final component that we add to that is because we really understand these businesses and we understand the US side of it, we were surprised to find that amongst other ETFs out there in the China space, there wasn't a clear screen for the types of geopolitical as well as kind of value-based issues that a lot of American investors do care about. So whether or not a Chinese company, in spite of what it's kind of does on the tin, is really kind of compromising American national security interests or American values. And so that's our core screen, alongside obviously looking for the best type of growth deals, but looking for companies that are infringing upon those two key aspects and then weeding them out of our portfolio, regardless of how great an impact they might have on growth. And we end up finding that we can outperform benchmarks, outperform our competitors, still by doing good. And so overall, even though China's been tough over the last few months since launch, we've still outperformed, and therefore I'm happy with where we are.
It's a fascinating story. What I love about well, there's many things that I think is interesting about everything you just said. One is we have this perception, or we love to say that boots on the ground experience makes all the difference when you're looking at portfolio management, when you're looking at active stock picking decisions and all that stuff. So I know we've talked about this, I think it was last year sometime when we first met. And we were talking about the different perceptions of what's the news is, what the reality is. We were talking about, if you remember, when the period when Jack Ma disappeared, and here on the West, we're all freaking out what happened to Jack Ma. And I remember you telling the story about golfing with him as we're here worrying that he's lost somewhere. So, tell us a little bit about, how different are the perceptions of what we have about the China opportunity, what's going on with the Chinese equities markets versus the reality of somebody who's living there, breathing there, working there?
Yeah. So again, maybe for people that are new to it, just to understand how that kind of opacity was created. It certainly has a lot to do with COVID, kind of the zero COVID approach that China took, where they locked out the kind of outside world for a few years. And there's very much a push-pull. China themselves obviously have pushed out a lot of Western media outlets. A lot of Western media outlets have also departed the country. A lot of expatriates have left the country. I think we peaked in 2008 with something like 8,000 or 9,000 American students studying abroad in China. Today, it's 700 students across all of China of Americans studying abroad there, whereas there are somewhere on the order of 200,000 Chinese students studying in the United States. So it gives you a sense of how much more they know about us than we know about them. China is an easy punching bag. It ticks all the boxes. It's a hot story. It's had a lot of ups and downs. Certainly, it is not in line with our values in the West in many ways, from a political perspective, moral perspective. But the simple reality is that there's a pretty negative general media bent against China, and so that kind of gravitates toward whatever is the worst possible variation or potential narrative or backstory behind anything that happens, and that becomes kind of the headline news that you read about in Western media. And the reality is could either be more complicated and more nuanced to what you presented, or it could be the exact opposite of that. I mean, we've had instances over the last couple of years where we've seen Western media reporting around major regulatory shifts in China that would make it more dangerous for global capital to come into the market. And it's the antithesis of what was actually going on, and the regulator themselves to kind of come out and dispel the rumor and kind of clarify that in fact that's not the case. And so we've seen a lot of those. I mean, Jack Ma was an easy one because, again, I think if you ask most folks around the world to name one Chinese national, would probably be Yao Ming and Jack Ma, kind of 1 and 2. And so that he was an easy name to go after, and he certainly was asked to take a step back, and obviously he's no longer involved day operations of Baba like he was. But again, I like this part of the story. I used to be a commodities trader in a previous life, and we made our money off opacity. We made our money off of people not knowing exactly where a price was, and us having intelligence days or months ahead of the rest of the world when it came to regulatory shifts or political developments within a country. So when I smell a disparity in information, I smell opportunity. So I like that. And that's, again, why I would put my money, if I were an investor, with someone that is on the ground and physically, with the regulators, with the business leaders, and not trying to trade China from London, New York, or even Hong Kong, which is in many ways still a world away from Beijing. And so, again, I think there's been a lot of easy narratives over the last few months that people have reached for, calling, for instance, the property situation a Lehman moment for China, or looking for these easy narratives around, youth unemployment rates, or just the overall kind of, a company gets raided by the police, or a Western company, their local subsidiary office gets raided by Western police, and that creates a narrative that it's dangerous for Westerners to come to China. And it's, and people even asking me when I'm in New York or San Francisco, do you feel safe there? Do you feel in danger when you go across the border or, step through immigration? And the reality is, of course, no. And it's a fairly isolated incident when a company gets raided, and it's probably because they were involved in some kind of a sensitive activity and didn't manage their local risk properly. But I like that. For me, it smells opportunity, and it means that we can, by being there physically, get ahead of the market, trade ahead of folks. The biggest challenge we face, though, is that as a whole, even if we know what's right and the fundamentals of the business are right, China is being still dragged down by that global inertia, by that global narrative that it's uninvestable or unpredictable. And so we'll have to find moments of opportunity where, we see that kind of shift long before other investors do on the narrative front. And then, of course, continue to invest in the fundamentals. And again, our businesses have outperformed other both indexes as well as actively managed funds doing similar things to date since launch. So we're certainly on the right path.
Yeah, it's interesting because I wanted to ask you about this hurdle. So this opacity does create a hurdle. So I think, when you think from a US investor perspective, an advisor, typically if you're going to go invest into China, you tend to go for, your broadest index base. Let's just own everything, because we don't fully see the risks. We don't fully understand them necessarily. Introducing an active manager is perceived, I think, to a lot of people as adding more risk to a situation where we already have very little visibility in. What is that hurdle like? Is it just a matter of education, telling the story like we're doing today? Or is there something else? Are there really deeply ingrained misconceptions about the risk in China that is actually leaving a lot of the opportunity outside of the reach of a lot of investors?
It's a great question. I think you have to trade active China today. And the reason is, if you were to just take a broad market swath, the reality is that certain sectors in China are not growing anywhere like they were before, because of, they've hit kind of saturation ceilings, because they've kind of matured, and they're now starting to taper down, because they've fallen afoul of the government regulators for certain sectors, because they are affected by geopolitics, and that's to say nothing of our core screen around values and national security, which, again, of course, if you're buying an index, you're going to have all kinds of companies that are falling afoul of U.S. sanctions, let alone U.S. values and national security interests. So if you care about those things, you probably don't want to be in an index to begin with. Second, we have to be nimble and agile, because while if I were to just buy a mutual fund kind of straight cut of the market, I think you get kind of modest to negative returns in China right now. If you pick the right couple sectors that we see have global growth prospects, so even if you're bearish China's economy, those companies are going to do very well because they are being driven by global consumers or emerging market consumers, Western consumers. Likewise, there are certain sectors in China which are very much within the regulatory slipstream of the Chinese government, where the Chinese government is pumping its own capital and regulatory support to ensure the success of those businesses. You've got to pick around to those spots and cherry pick names. And then in our case, I think you have to be more concentrated as well. We could easily dilute ourselves and dilute our returns downward if we just kind of bought a straight kind of even percentage of different businesses. So we are actually consolidating our portfolio, putting more into a few key positions that we think very strongly of for very specific and systematic reasons. And I think that will yield much better returns than the average, which, again, the numbers speak for themselves.
Man, let's talk a little bit about the decision to launch an ETF. Like your firm has been in the private markets in through its whole lifetime, and so the ETF is the new thing. What was that decision-making process like? Why all of a sudden you decide to launch an ETF? It's listed in the US, it's a US listed ETF. What was that decision-making process like? Why now? Why here? Is it just an opportunity? You found a spot in the market. There's not a lot of actively managed Chinese ETFs, or was there something else? This somehow enables you to deliver on your value proposition in a better way, reach a broader audience. Walk us through that conversation.
Sure. So I think that, I think at first there was a realization that, and many painful moments over the last 4 years or so, particularly, and of course, even over the last 8 years, where we had pretty interesting intelligence around a publicly traded name, but couldn't take any action on it because we are sitting on the private side. And so we watched friends of ours make tons of money on the public side. And of course, we could trade it on our public account, but nowhere near the scale that I thought would, kind of build an asset management platform and kind of a public track record the way we could if we had our own dedicated vehicle. And so that acute kind of pain just kind of got more and more incrementally higher, really culminating 2 years ago, or a little less than 2 years ago, in October 2022, when you had, following kind of a Chinese Party Congress, the one where Xi Jinping was kind of re-anointed for his next term, you had an announcement of who was going to be in the Politburo, kind of the core, kind of key positions within government. And the day after that, the market just tanked. I mean, just went down by, I don't know what it was, many names down by 20, 30%. That to me was the biggest obvious buying opportunity of all time, because it was going down for really no fundamental reason. People were just kind of perceiving that the people that were brought into the Politburo were loyalists and maybe less technically oriented or growth oriented, which actually wasn't even the case. Again, it just shows you how little knowledge of their bios and backgrounds the Western kind of media had. And so, on that day, I even went on CNBC and said, buy, buy, buy. And the market, many of those names doubled within months or even days, but we had no ability to take action on it. So that was really frustrating for me. And so that was kind of the last straw where we started thinking we need to have a public strategy. I like ETFs. I think they're a kind of an emerging asset class of the future. I think people are kind of tired in some ways of the traditional hedge fund approach, maybe even a venture and growth, some of our historic products. Because of the tax benefits of an ETF, because of what are obviously lower economics, lower kind of price point for investors to get involved relative to the other kind of asset classes that we're accustomed to, that made it appealing. The fact that it's easily tradable. I mean, again, if I want to get into a hedge fund today that's trading China, it's not that easy. I've still got to go meet their IR team. Probably their best fund is a medallion fund or something like that, which at this point has done so well they don't need my money anymore. It's only available to friends and family or employees' capital. I saw that happen with some of the best hedge funds. And so I thought this was a more democratized format of putting our best ideas into a strategy that was easily accessible. So if someone watches this this interview today and this resonates with them, they can come buy it, within seconds on their stock trading app. So I like that kind of efficiency and immediacy of it. And obviously I spent a lot of time in the media trying to demystify China. And so I thought it was a kind of a nice compliment that we could talk about it. And our objective obviously is that one day our stock, and the underlying positions behind it is seen as truly a bellwether for the Chinese market and the true growth potential of it. It's easy to just kind of look at a generic index that looks across all sectors and say, well, China's down. But if you cherry pick the right sectors and the right names, the growth picture changes radically and gets a lot more optimistic. So hopefully people can look at us as kind of the China growth potential index and not the China kind of diluted, watered down growth picture.
Has there been anything in this process that has surprised you? I know the benefits of the ETF are so beautiful, but it's not an easy industry to get into as a first timer. So what stands out as parts of getting into this business that you didn't expect, whether it is telling the story, finding traction, or what else could it be?
I think the administrative side and the setup side and the support that we got from the NYSE and from our partners and on the kind of trust side has been tremendous and really efficient. So I love that side of it, far more efficient than any other asset class I've ever been in. The frustrating part for me, coming again from a more traditional fund perspective, is I can't talk to my customer directly. I mean, I want to sit in front of the RIAs and answer all their questions and be an open book and demystify China and tell them things about the market that they didn't know, and maybe it's relevant to our fund, maybe it's not, but really help to be an information bridge. And I don't get to have that one-on-one kind of engagement with our investors, and so that's frustrating for me. It's probably the biggest kind of difficulty I'd say I face. We're finding ways around that, but it's something I miss because I like engaging with the humans that have put their confidence in us, and if it's their life savings or if it's their pension or their endowments capital, I want to speak with them, and I want to assure them on a human level that their money is in good hands, and I don't get to have that kind of interaction.
So Ben, as we wrap up here, should we expect to see other things? Are there other opportunities you see coming down the pipe when you think about developing a family of ETFs? Is this what's under your radar as far as where to go next?
Yeah, so as I said, we definitely will have other products. We don't want to launch anything where we wouldn't say hand on heart, we would put our own money in this product and we have some kind of a competitive advantage. It feels like, people are starting to just launch products because it's the flavor of the day. Obviously there's a lot of noise around Bitcoin ETFs today. I get that it's an easy asset class for people to buy into, but obviously the people that are selling those don't have any edge on Bitcoin that we don't have, right? So I would only bring to market products that I feel like align with the track record and experience we've built over the last nearly decade of private market investments, where we again have some kind of an information edge. And so for us, the next product would be something in that emerging market space, where we again feel like we've been trading it for years. We know the intricacies of it. And again, we looked at the competitive landscape, other ETFs in the market, and don't feel like they are providing the kind of product that we could. And then the next one will be, the third one will be more around the US-China dynamic, but more from a US perspective, how the US benefits from decoupling, how the US sees growth in digital infrastructure. And again, it's something we feel like we know about it well because we know how the separation of supply chains is happening. We see it firsthand in China. So we know what really is narrative or fact from fiction, narrative from reality when it comes to what truly can be offshored, what high-end manufacturing is feasibly moved, what's not, who are going to be the beneficiaries of, again, geopolitics and executive orders that affect Chinese businesses. So things that we think would be value additive. So, and again, with a really unique perspective. And we seed these funds with our own money. We feel very strongly about this. This is where I'm putting my own money as opposed to, I don't know, investing in some other asset class. And so we're really aligned with our investors as well. So we'll do more products where we feel like we have that competitive edge.
No, that's great. Now for the final question, I just have to say, or more a statement, like loving the soccer jerseys in the back. Who's the favorite soccer player at the moment?
I'm what a co-owner of a team in La Liga in Spain. That's where my heart sits. It's always a painful journey. When you own a team, it's very different than investing in a company. You don't have shareholders, you have fans, and the loyalty of a fan to their club is very different than a shareholder or a customer to a company. These are people that live and die by our crest, and your only KPI in life is to make them happy, and you make them happy obviously through performance on the field, and that's not always easy. So I think I have a lot of sleepless nights about that too. But it's been obviously had an incredible experience of highs and lows. But being a custodian of a historic club is something that was always my dream, and I spend what little free time I do outside of our asset class and investing on that, as opposed to, I don't know, playing golf or something else. So that's my passion.
I'm sure
But
there are a
before
lot
it would
of
be really
parallels there
great.
between soccer and asset management. So, listen, Ben, congrats on the ETF. Again, CoreValues, Greater China Growth ETF, ticker CGRO. We're looking forward to seeing you on stateside. So, holler when you're in town. And thanks for joining us today.
Will do. Thanks for having me.